Welcome to a new episode of Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. This, of course, is a podcast that will make you a smarter investor, or I hope. I have to start out with my stock of the day. I am still very much thinking about the big Yahoo Finance Invest Conference we held in New York City. A whole group of amazing guests rode onto our main stage for some fabulous conversations. You can go check out all those conversations in Yahoo Finance. But the stock of the day for me is Bank of America. I sat down with Bank of America Chairman and CEO Brian Moynihan, talked to him at length for about 20 minutes. I mean, it was a big conversation about the future of his bank and the Trump administration. Two things stood out to me as I digest this conversation. In that moment, you kind of lose track of life and what you're actually doing. Brian's saying he thinks there's going to be less regulation under the Trump administration, and that might impact the banking industry. Of course, we've seen bank stocks on fire after the election or the re-election of Donald Trump. The KBW Bank Index up 10%, Bank of America shares up 10%. Brian is specifically looking at Basel III capital requirements. Now, Brian has been talking about this at length. I've talked about this with him in the past, how restrictive these regulations could require banks to hold more capital on their financial statements or their balance sheet. That means maybe they return less capital to shareholders. If those regulations are dialed back, could be good for bank stocks. They could give more capital back to shareholders. Also, I'm also reflecting a bit on what Brian told me about the impact of lower interest rates. He's looking for one more rate cut this year, 4 rate cuts next year, and how that might impact consumer spending. Brian, I think, struck a bullish tone on the state of the consumer as it pertains to the holiday shopping season, in part because of those lower interest rates. But of course, you can check out more of that interview with Brian Moynihan on the Yahoo Finance platform. And of course, you can check out the statistics and the valuations of that Bank of America company, one of the world's largest banks, on the Yahoo Finance ticker page. All right, let's get to our interview of the day. One of my favorite economists, Chief U.S. Economist at Deutsche Bank, Matthew Lazzetti. Good to see you, man.
It's good to see you too.
Welcome to the pod.
To be back.
Appreciate it. Yeah, good to see you. So we, look, our conference it's just in my head. I have a lot going on. One of the guests was Neil Kashkari, heads up the Minneapolis Fed. And I think Neil had a really great comment to our Fed correspondent, Jen Schonberger, saying it might take an inflation surprise for them not to cut rates or take a pause before year end. I mean, what do you think about that?
Yeah, I saw those comments. I was honestly modestly surprised, I think. They leaned a little dovish to me relative to what I was anticipating. And maybe just to kind of set the backdrop for the Fed heading into that December meeting, and we have a CPI print later today, which will be important. But when you look back to September, the Fed was kind of finally balanced on delivering one more 25 basis point cut this year. There was 9 officials that didn't expect to cut in December, essentially. And then you look at the data flow since then. We've had a very strong jobs report, then a mixed one given the hurricane and strike effects. You had upside inflation surprises. Financial conditions have eased considerably with stocks near record high levels. And so that backdrop is one in which the incoming data flow, I think, make that decision in December more marginal. I think it is not necessarily a low bar for them not to cut in December. You overlay on top of that the election outcome, so prospects for tax cuts, trade policy that could be inflationary, financial conditions easing even further. And so while I do think it makes some sense that you need to get higher inflation to not cut in December, I'm not sure that the bar is all that high for them to skip that meeting.
Out of all the data that you study, are you seeing any signs that inflation is coming back?
So, when we get inflation later today, a few things we'll be watching. Used car prices, we think pick up. Now, that's not this.
They're never cheap, man. Someone who buys used cars, they're never cheap.
Absolutely never cheap. From our perspective, you typically look at wholesale prices, and that feeds through into to the consumer prices. So that should pick up. We're always focused on rental price inflation. That has remained sticky at elevated levels. Outside of that, there's not much evidence that inflation is remaining too high or too hot. But two things that concern me at the moment, and this is a little wonky, but there's something called residual seasonality in the data. And it's just the fact that early in the year we get higher inflation prints, later in the year we get lower inflation prints. And so I'm worried that as we get to the start of next year, we again see this kind of resurgence in inflation pressures. That's one thing that worries me, and I think should worry the Fed a little bit. The second thing is just the policies that could be coming. Trade war, significant increases in tariffs would absolutely increase inflation next year. And I'm not sure that that's kind of very well reflected in terms of consensus expectations.
I've saved about 12 minutes. I want to dive into each potential policy thing from the incoming administration. But on the consumer, you heard some of my comments. I was talking to Brian Moynihan about the state of the consumer. How do you see the consumer this holiday season?
I think you have to, there's only one way to view it, which is kind of solid, and fundamentals are very resilient. I think there's been an evolution in the thinking of the consumer over the course of this year. as you went through the summer, we had a slowing labor market. The unemployment rate was rising, job gains were slowing pretty clearly. And the savings rate that households had dipped below 3%, was near historically low levels. So it was looking like a consumer backdrop from the macro perspective that looked a lot more fragile. A lot of that's been revised away. So, as we often do,
how data works.
as we often do with the revisions, we found more income for households.
Somewhere.
The savings rate went from 2.9 up to 5%. That looks a lot more stable. Wealth is near record high levels relative to income, so that those wealth effects are supportive. The labor market bounced back. Income growth looks very solid, and so consumer fundamentals are, I think, looking incredibly solid heading into this period. Consumer spending trends have been very resilient. If I could maybe go back to the first comments just once, I think if we are predicating a strong consumer on rate cuts, that becomes a little bit more problematic. I don't think that the consumer needs that, but the backdrop that I was just outlining, where inflation could pick up again next year, the prospects for material rate cuts next year have been dampened.
But not every consumer is doing well. Is the consumer economy simply still being powered by the higher end?
So I think the answer is generally yes. The way that I view it is the consumer and the economy was incredibly abnormal in 2021 and 2022. You had an economy where there was excess savings across the income distribution. So household balance sheets were in very good shape across the income distribution. The need for borrowing was not really there. And you had very rapid wage growth at the lower end of the income distribution. All those things were very helpful for the bottom half of the income distribution. Since that time, I think what we've seen is mostly a normalization, which is the excess savings is now gone from the bottom half of the income distribution. Price pressures have picked up materially there, so delinquency rates have picked up as a result, and you do have an economy that just looks a little bit more normal from a pre-COVID perspective, which does tend to be driven and powered by the upper end of the income distribution.
How confident are you that a lot of folks that I've talked to, economists recently, they're looking for the job market to bounce back from that October surprising print? And I get why it was so low, but what if it doesn't bounce back?
Sure.
Are you that confident that we're going to see that re-acceleration into your end?
Sure. So, going back to that data, there's two things that we think were a big impact. One, you had the strike effects, which was at least 45,000
Was the Boeing?
jobs.
Boeing
strike.
Gotcha.
The second was you had hurricane effects. Now, those are always difficult to identify, but when you look at, there's a data series that's the weather workers. These are people that were not at work due to inclement weather. It was the highest in October on record, dating back into the 1970s. So it does suggest that there was also material weather effect there. Ultimately, we would expect a bounce back. But when you look at the overall trends for the labor market, I would say it's more stabilization to still easing rather than a reacceleration.
Yeah, I asked this because when I talk to CEOs, I don't get the sense that, we're hiring. I think I just saw news cross today that Chegg was laying off 21% of their workforce, second layoff since June. And they're having some AI and there's some structural reasons there too. But I don't sense that, let's just get out there and add more payroll.
Yeah, and I mean, you see that in the data. So we have this JOLTS data, which shows the hiring rate. That's remained pretty low. And so you still have a labor market that looks like demand and hiring is relatively low, but also layoffs are historically low. And so with that dynamic, you kind of have decent job gains that are taking place, a stable labor market backdrop, but not one that's necessarily reaccelerating, which you would have concluded from that September jobs report.
We've talked to you a lot this year. As we are now approaching year end, as you look back, what has surprised you about the economy?
So there's been a number of things over the past several years. If you go way back to 2022, we thought that the aggressive rate hikes that we were going to need from the Fed, I think we were good in anticipating how aggressive the Fed would be, but we thought that was going to have much more negative effects on the economy. Ultimately, it didn't. The economy has just powered through higher interest rates to an extent that we didn't anticipate. That's due to a few things. I think fiscal policy has been looser than we thought, and there's been some lagged effects of that. Savings have just been higher. You've had supply side developments that have been really positive. So productivity growth is really accelerating in the US. Plus you had a big pickup in immigration, which helped to kind of ease labor market strains. So those things together, I think, have been delivered very, very good outcomes for the economy relative to what we were anticipating in 2022. As we look ahead, I think that there's just kind of comfort around the disinflationary trend that is there. And as I mentioned, that's one area that I'm just a little bit more worried about, that particularly with an economy that does look so robust and resilient, a labor market that is resilient, if you overlay tax cuts on top of that, plus trade policies that are going to be inflationary, do we find ourselves in a little bit more of an uncomfortable environment next year?
Before we go to break, that mention, that shout out on greater productivity, is that the first sign like AI is having a real, like it's embedding itself in companies, and this is going to be a bigger thing that maybe people don't realize?
I don't think it's AI yet. I mean, we are beginning to see it in some elements of the data. You can see that orders for computer and related equipment have picked up. Imports of chips have absolutely exploded.
Thank you, NVIDIA.
Imports of chips have kind of absolutely exploded. When you look at private investment in the US versus other economies, the US is on a completely different scale than other economies. But I don't think what we're seeing in the productivity growth data is reflecting that yet. I think that's to come. What I think productivity growth is reflecting is just a historically tight labor market tends to incentivize businesses to undertake CapEx, capital deepening, productivity enhancing environments, and then it follows through. So we're kind of following that typical trend that you would have from a tight labor market, high wage growth, incentivizing firms to invest.
So next year we all lose our job because of AI bots.
I'm hopeful. As an economist, I'm especially hopeful that we don't.
All right, hang with us. We'll be right back here on Opening Bid. All right, we're having a fun chat with one of our favorite economists here at Yahoo Finance. That's Matthew Lazzetti from Deutsche Bank. So I specifically saved the last 12 minutes to all things Trump policy. I want to go tick by tick to break this down. Tariffs. Would they be inflationary, and would they hurt the economy?
So I think if you go back to 2019, one good thing here is that we have experience with this recently. In 2019, you had tariffs which were primarily focused on China, but they were also focused on steel and aluminum and other items. What we saw in the economy in 2019 was some uplift in inflation. It was modest. We identified a 15 to 20 basis point uplift to inflation from those tariffs. And you actually saw an economy which did come under pressure as a result of the tariffs. Now, it kind of sparked a trade war. Financial markets took it very negatively. If you go back to 2018, late 2018 into 2019, you had a China devaluation that sparked this big sell-off in markets. But you can actually see, the manufacturing sector, industrial production had picked up in 2018, and then it actually was down. It was negative in 2019. Manufacturing employment had flatlined in 2019. In manufacturing had came off. So I think we have kind of clear evidence recently that tariffs do work as we expect, which is it is a negative supply shock for the economy in the short term.
Okay, so
inflation picks up, growth is negatively.
Is that okay? So now another line. Is that would tariffs be stagflationary or a precursor to a recession?
So in that context, stagflationary meaning that it have high unemployment with high inflation. It would directionally push those things in that direction. Now, I would not suggest that tariffs will give us stagflation. We're coming from an economy with an unemployment rate close to 4%, not nearly a stagflation environment. We're also coming from an economy where core PC inflation is 2.7%. Again, not kind of close to a stagflation environment, but directionally, it would tend to lift unemployment and lift inflation at the same time.
I go back 2 weeks ago. We talked to the CEO of Brooks Running. He was sitting in your seat. I asked him, "What if you get tariffs? Can you push those prices up another 20%?" No. I mean, what happens? What if we have sticker shock down the aisles after these tariffs? Is consumer spending, does that fall off a cliff?
So that is kind of an open question. From my seat, we have to say, if we were to get 50 to 60% tariffs on imports from China, how do you factor that into inflation? And there's a number of margins through which that can be dissipated. So, currencies can change. Perhaps they don't pass it on to the final consumer. Exporters from China to the U.S. may reduce their prices to keep market share. So it's a really difficult one to quantify, and there's a lot of attenuating circumstances there.
What do they do over time then? Tariffs, longer term?
So I mean, we have less experience with that. I think that the hope of the Trump administration, and you can see this very clearly in Bob Lighthizer book, that the hope is to reorient the global economy to bring manufacturing, employment, and production back to the U.S. I think what we have learned is that cannot just be tariffs on one particular country, because it is unlikely that reorients that production, say, out of China into the U.S. There's a lot of other stopping places that you get before that. So the Trump administration is also considering this universal baseline tariff, basically a 10 or 20% across the board tariff that would impact all imports. And so they're hopeful that that could help to bring back manufacturing activity over time. The jury's out, I think. I think we know the short run effects so far from 2019, which is it improved the trade balance with China, didn't necessarily improve the trade balance more broadly. It negatively impacted kind of manufacturing, employment, and industrial production, and it lifted inflation modestly.
Immigration, deporting millions of people. What is the potential economic effect of that?
So we've done some work on the disinflationary effects of the immigration boost that we had over the past several years. And when you kind of work its way through the labor market. So one thing that it did was we had a lot of excess labor demand. Job openings were incredibly high. And a big pickup in labor supply was able to reduce kind of job openings and the gap with that and the unemployment rate. So it eased how tight the labor market was pretty significantly. Our view is that it probably reduced core PC inflation 25 to 50 basis points last year. That's meaningful. So if you were to reverse those flows, it would absolutely be a tighter labor market and higher inflation. From a growth perspective, there's been some really good work done by Brookings recently. And they looked at if there was larger scale deportations, that it could reduce growth by 40 to 50 basis points over the next year. Again, that's material.
That's a lot.
So if I were to tie these two policies together, they have some similarities in that they are negative supply shocks for the economy. They would tend to reduce growth and lift inflation, at least over the short term.
How does the U.S. economy make that up?
So we're starting from a strong backdrop, to be clear. Growth has been running at about 3% for the economy. Next year we would anticipate that you get a renewal of Trump's tax cuts. That will be important, but it's importantly also not new stimulus. It's maintaining the status quo for tax policy.
Can these tax cuts go through, given where deficits are?
So I think they can go through, but it will also mean very large deficits as we look ahead. So just to maybe provide some context, if you look at the CBO, the Congressional Budget Office's projections for deficits relative to GDP, over the next 5 years, I think they average about 6%, which is historically large, particularly for an economy that is operating well, not in a recession. And that assumes that the Trump tax cuts go away. So if those get renewed automatically, that adds about $4 trillion cumulatively to the deficit. So we, and I think the markets, are anticipating that you will have very elevated budget deficits as we look ahead. That should mean higher interest rates. We had a period last year where the market was just heavily focused on this. And I think that becomes a key topic for the market again at some point over the next year.
Should. Like what's the tipping point? I mean, you and I, we've watched the past 10 years of our career, deficits just go up and to the right. I mean, when does it all break?
Yeah, I think what we know is identifying a tipping point is very, very difficult, if not impossible. We also know, if you look at other economies, I would not extrapolate experience to the US. So if you look at the relationship between debt and interest rates, all of the action essentially comes from Europe when you're looking at advanced economies. Other economies, debt to GDP in Japan is incredibly high, much higher than it is in the US. The US is also very elevated, but there's very little relationship between interest rates and debt to GDP. So the US as a reserve currency, as being a market that does attract a lot of capital, has a privilege where we are able to run larger deficits without it impacting interest rates. That doesn't mean that it doesn't have a spillover effect, and from July through November of last year, it did. The curve steepened, term premium was built in, markets sold off as a result of that. That will absolutely happen at least periodically and sporadically when it becomes the key issue that markets are focused on.
How do you and your teams, or how are you preparing for another 4 years of President Trump?
So, I mean, right now it is quantifying what we anticipate from a policy perspective. On the trade side of things, I think we should take the incoming administration close to at their word for what they've outlined. Maybe not the exact scale and the sequencing, but I think if you go back and read Bob Lighthizer book, it is very clear that the administration for several decades has a strong view that we need to do something on the trade front. So we will think and anticipate that tariffs will be implemented. We're also thinking through how tax policy will be adjusted and impact the economy, and building that into our forecast over the next year. But the reality is also going to be predicting exactly how this plays out ahead of time.
It's going to be brutal.
We know that we're not going to get all those assumptions right.
Yeah.
So really having to be nimble in the forecast, responding, adjusting the forecast as we get new information, that's just going to be a fact of life.
Is the Trump economy, and you bring up a good point, is it just going to be more chaotic, like less, is it going to be harder to predict, I guess?
So I think it is harder to predict. For somebody that sits in my seat, there is more policy changes. They're bigger policy changes. There's going to be a lot of things that get proposed or floated that don't ultimately get implemented. At least that was the lesson from last time. So from our perspective, yes, we have to just be a lot more nimble.
Right?
We have to, yeah. But also, it's good for us in the sense that, as a macroeconomist, we have to have views on how tariffs implement the economy. These are critical and important issues to think through how tax policy will matter, how deficits will matter and impact markets.
Is geopolitical risk underpriced in this market?
I don't know that it's underpriced. As you go back to the maybe the first Trump administration, we got through that period without very strong geopolitical tensions. Clearly it's a different world at this point in time. It's hard to predict, I think, how things will play out. Certainly in things like oil prices, there's not maybe a meaningful premium being built in there. But on the other side of that, I think the market is also anticipating that you could see a big pickup in energy production in the U.S. that's offsetting some of that. So I think it's hard to tell exactly whether or not it's well priced or not.
In the last minute and a half that we have here, we like to ask our guests for a hot take. Floor is yours. Hot take on the economy, a prediction for next year, whatever you got.
Yeah, so you might be able to anticipate from some of my comments before. But I think the market has been very conditioned to say that the Fed is cutting rates. We're in a rate cutting cycle, and that's essentially where we're heading. And you can see market pricing assumes that as well. I think that's discounting what are very big policy changes that are coming, and as I mentioned, policy changes that are likely to be inflationary. And for a Fed that already has inflation above their target, this is a really problematic and difficult and dilemma-filled time over the next 12 to 18 months. And so I think if there is something that could be surprising, it'd be that the Fed doesn't just skip a meeting here or there, but that they ultimately have to undertake a pause next year at above 4% on the Fed funds rate, and that we actively then begin to debate, do they need to raise rates again or not? I think that debate and discussion is not really part of kind of the base case for markets at the moment.
Yeah, there's lots of it. It's euphoria.
Correct. So I think if one thing that could be somewhat surprising, it would be the economy continues to chug along well. We get tariffs overlaid on top of that, which is inflationary, and the Fed has to debate which direction they should be going.
Matthew Lazzetti, always nice to talk to you. I'm sure it's going to be a busy 12 months for you and your teams. Chief U.S. Economist over at Deutsche Bank. Always a great get some time with you. Appreciate it.
Thanks so much for having me.
All right, that's it for the latest episode of Opening Bid. Be sure to hit us with those 5 stars on Spotify, the thumbs up on YouTube, and wherever you find this podcast, just keep showing us the love. We really appreciate it. It keeps us going every single day. We'll be right back.